Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We're going to be talking about the very first chapter. What is accounting? Accounting for what? How do we account for things? What are transactions? What is the accounting equation? These are the things we're going to be talking about now. And just before we jump into this chapter, in the classroom, Module 1, Week 1, Chapter 1. Chapter 1, PowerPoint. Chapter 1, Quiz. That's what we're talking about right now. So let's go ahead and jump into the first chapter. And again, the reason why we're going through 2 chapters each week is because this is an 8-week course. We got 14 chapters to get through. Okay, so what is accounting? What is the purpose of accounting? Why do we do this, right? What is the whole reason of this? Accounting is simply called the language of business. Why is accounting called the language of business? Because it tells us, it talks to us. The language of business is how we talk when we're talking about business transactions. The reason why accounting is so important is because it helps us to identify a transaction that is taking place. A transaction is simply an exchange of goods and services for something else, like money or other goods and services. We identify what is happening. It's an event, a transaction. You went to Macy's recently, you bought a red t-shirt at Macy's. That's a transaction. We're identifying that transaction. You brought the red t-shirt at Macy's to the register. We identified that process. Now we're going to record that transaction. That's the second step. You're purchasing a red t-shirt from Macy's. In exchange, you're giving Macy's cash. That is a record of the transaction. Macy's received the cash. You received the red t-shirt. That's a transaction. That is a recording of a transaction. You get a receipt, right, with your red t-shirt. That receipt, that's the receipt of the transaction. So what happened there? Macy's debited their cash. They increased their cash. They credited their inventory to reduce their inventory. That's the transaction. And this transaction gets recorded as a journal entry. And that journal entry goes on to what we call the income statement. The income statement is one of the statements, statements that we'll be talking about. The income statement records revenues and expenses. And that information goes on to the income statement, and at the end of the month, we have a full income statement, balance sheet, statement of cash flows. These are the financial statements that get prepared, and we communicate that information to management so they can make good decisions. This is kind of how it flows, right? That's why accounting is important. That's why it's important for us to record transactions. There's a lot of people that are interested in accounting information. We have 2 types of people. We have external users and internal users. External users of accounting information are all the people outside of the company. They're external of the company. A couple of people will be interested to know what's going on over at Macy's. Who are those people? That's the government. They want to know about the taxes that Macy's is paying. That is the regulators, the government, right? Who else is interested to know what Macy's got going on? Lenders. The banks want to know what Macy's is doing with their financial statements. Shareholders, people who invest stock, they purchase stock from Macy's. Those are shareholders. They're concerned about the financial statements. External auditors, these are the people that audit the financial statements to make sure that they're correct and accurate. They want to know what's going on with the statements. The board of directors, the customers can be interested in knowing how Macy's is performing. Those are external users. Remember, the word external means outside of the company. Outside of the company. They're external. So that's one set of users of the financial information. The other set is called internal users. These are people inside the company. Internal, inside the company. People that will be interested in financial information would be the managers, of course. All different kinds of managers. R&D managers, purchasing managers, human resources, marketing, production, distribution. Yes, the people inside the company are concerned with the financial statements because they need to be able to manage off of these financial statements. Alicia, do you have a question? You okay? Sheila?
Oh, I'm sorry, sir. I hit
okay.
mute by
It's
mistake.
okay.
My
No worries.
apologies.
I just wanted to make sure you didn't have a question. No worries. So internal users, that's the people inside the company. They're concerned with the accounting information. That's how they make decisions, yeah? There's a lot of different types of accounting. Okay, there's a lot of different accountants, a lot of different types of accountants. We're not just one kind of person. Okay, accountants are a lot of different type of. There's a lot of different roles in accounting. There's financial accounting, managerial accounting, taxation, and things that are related to accounting. There's a lot of different opportunities in accounting. In fact, accounting is an area of need. We're hiring a lot of people in this field. Financial accounting is what we're talking about in this course. Managerial accounting is what we're going to talk about in Principles of Accounting 2. Then we have taxation and other related accounting services. These are all different types of accountants. And these are all different types of people that are concerned about earning money, paying taxes, investing, budgeting, and planning for the future. They all are concerned with accounting. That's why accounting is so important. It doesn't just play one role in your life. It plays a lot of different roles. It's important for people in accounting to be ethical. Wouldn't you say? You want your accountant or somebody who's doing your taxes to be honest? Of course. You want them to make good decisions? Yes. We want anyone dealing with money to be ethical. What does it mean to be ethical? It means to practice good behaviors, to be honest, transparent, to show honest information. That's what it means to be ethical. It means to be honest and transparent and always do the right thing. That's what it means to be ethical. Make ethical decisions. With money accounting, there's always an opportunity for fraud to be committed, unfortunately. Unfortunately, not everyone is ethical. People use accounting information to deceive others. That is unethical. That is also called fraud. To deceive someone else for financial gain is called fraud. You don't want to commit fraud. Fraud is bad. Okay? Fraud is very bad. It will land you in jail in most cases, yeah? A couple of cases I can remember, Enron being probably the most famous one, 1998. A couple people went to jail from that case. Health South is another one. There's so many different cases that I can go through in the legal history where investors and even employees were defrauded by the company for the financial gain of a few. And it's so important to be ethical, especially and honest and transparent when you're dealing with money. So what came about some of these fraud actions? Well, in 2002, Congress passed this law called the Sarbanes-Oxley Act. And what that did is it provided honesty and transparency verification of financial statements by external parties. What this did is it provided assurance that publicly traded companies were not defrauding the public. That's what the law provided. The Sarbanes-Oxley Act of 2002 helps to prevent fraud from happening. The act is 20 years old now, so I imagine that they're looking to examine that a little bit closer as time marches on. Another act Congress passed was called the DoddFrank Act to help consumers to be protected against various things that companies sometimes do. Protection for whistleblowers, protection of consumer rights. That's what these acts did. And the reason why we talk about things like fraud when we talk about accounting is because, again, anytime money is involved, there's an opportunity for somebody to not act ethically. And so it's important to understand how that happens, why that happens, and how to protect that from happening in the future. But since this is a principles of accounting course, we got to talk about the principles, right? And so we're going to shift gears a little bit now from talking about fraud and that kind of stuff to talking about the accounting principles. These are the foundations of everything we're going to do over the next 8 weeks. The generally accepted accounting principles. These principles govern what happens in accounting. The generally accepted accounting principles provides the framework and the rules that we as accountants use as we record transactions. There are two parts to every transaction. There's a debit and a credit. You probably heard that somewhere before. Even if it was just looking at your checkbook, there's a debit and a credit column. Okay. The reason for that is because with every transaction, there's an exchange happening, right? You're either paying money or getting money for some reason or another. And there's an exchange happening there, right? When you're receiving money into your bank accounts, probably because you worked, right? Hopefully, it's because you worked, or you earned it somehow. Yeah, there's an exchange there. You worked, or you contributed, or something happened. So something came out and something came in. There was a debit and a credit. Yeah, two things happened. And the government generally accepted accounting principles helps to govern transactions. It also helps information to be reliable, transparent, and meaningful to the users. Other governing bodies of accounting, there's two other ones. The generally accepted accounting principles is what we use here in the United States. Other countries use other standards, but they're really similar. Okay, they're really, really similar. The International Accounting Standards Board and the International Financial Reporting Standards, which both are pretty much the same now, are used to identify accounting practices around the world. These help to govern other countries. But the United States and a lot of these other countries came together recently. It's called a convergence. And this convergence is really helping to create a set of standards across the whole world. So you can work for a multinational corporation like Coca-Cola or Toyota or a big multinational corporation. Multinational means they have operations in different countries, yeah? And for multinational corporations, it's good to have one set of standards. And that's what this framework is doing. It's creating one set of standards for operating around the world. And the standards are very clear. It helps us to understand when we recognize revenue. It helps us when we recognize expenses and how things are reported. It creates a set of standards around the whole world. So all the countries that the company operates in operate on the same standards for accounting. But here in the United States, and throughout this course especially, we're very focused on the generally accepted accounting principles. Because this generally accepted accounting principles helps to govern accounting. There are 4 primary principles that we're concerned with in accounting. We have the revenue recognition principle, the expense recognition principle, how we measure, and how we disclose. Those are the four primary principles we're concerned with. And we're going to break down each one because these principles are very important to understand. This helps us to understand how the transactions work. First one's called the measurement principle. This is also known as the cost principle. Cost, C-O-S-T. This is where the accounting information is based off of actual costs incurred. There are two different types of costs. There's actual cost and there's estimated cost. The actual cost is the actual cost. For example, my company manufactures pencils, the number 2 pencils. We manufacture pencils, okay? And it actually costs the company 10 cents per pencil in lead. It actually costs the company another 20 cents in wood material. 10 cents in lead, 20 cents in wood. Those are actual costs. That's what I actually pay for those materials. I record those actual costs. That's part of the measurement principle. The second principle is called the revenue recognition principle. This principle tells me when to recognize the revenue I'm receiving from my customers. Revenue is from sales. When you sell something, we call that revenue. For those of you in the hotel business, you know what I'm talking about when I say that. You know it as room revenue. Okay. For those of you in the retail business, some of you who are starting your own businesses, you're going to be selling certain things like crochet stuff. You know what I'm talking about. When you sell your crochet stuff online, on the social media, on the whatever, and you receive cash from your customer or a check, whatever, that's revenue that your business is taking in. So when do we record revenue? That's important to know. Revenue is not recognized until the goods or the services have been received by the customer. Okay, what does that mean? Let's say I have a crochet business, and so I get a customer who purchases one of my crochet things, yeah? I don't recognize that I received the revenue until my customer received their blanket or their pillow or whatever it is that they ordered, yeah? They might send me the cash before I make the crochet, but I don't recognize that cash as revenue until my customer received the product that they ordered. Okay, that's called the revenue recognition principle. It's when we recognize revenue at the time that the goods or the services have been received by the customer. Okay. Very important to understand that, because there's two types of revenue. There's unearned revenue and there's earned revenue. Unearned revenue is when I receive cash from my customer, but I have not yet sent the good or the service. It becomes earned revenue when I have sent the good or the service to the customer. It's all about timing. It's all about timing and recognizing revenue. The third accounting principle is called the expense recognition principle. This is also known as the matching principle. And this is when I record my expenses at the time they've been incurred. At the time they've been incurred to generate revenue. It's called matching. I'm matching the revenue with the expenses at the time they've been incurred. Here's what that means. Let's say I receive my electric bill, okay? My electric bill was for last month, But here we are, January 10th of 2022, and I'm receiving my electric bill from December 2021. According to the expense recognition principle, I need to allocate that expense of electric to the month of December for the previous year. How do I do that? I record the date of the transaction and I allocate it to the previous year through a journal entry. What I'm doing here is I'm matching the expense of electric to the month in which it actually happened. That's when it was incurred. When something is called incurred, that's the time of when it actually happened. Because you might get a bill the following month for something happened during this month, right? Like, for example, electric. You get your electric bill after you've consumed the electric. So you have to record that bill for the month in which it actually happened. That's called the matching principle. And the fourth principle is called disclosure, the full disclosure principle. This is when the company reports the financial statements to the users with notes to the financial statements. Basically tells us what happened in those transactions. Disclosure. When you disclose something, you're telling the story. You're providing all of the relevant information. Disclosure. So those are the principles. Those are the four principles of accounting that we're going to be talking about throughout this entire course. And I'll show you how a lot of examples as time goes on. There are also, in addition to the principles, of course, there are a couple of assumptions we need to make. The first assumption is called the going concern. The going concern is, how long can this company operate before it's closed or sold? The going concern. How long can the company last? Why is that important to know? If I only have a certain amount of money coming in and I have a certain amount of money going out every month, how long can I last? That's called the going concern. Yep. Every company closes. Nothing is permanent in this world. You know that. We don't last forever. People don't last forever. Companies don't last forever. In fact, a lot of companies, such as a certain serial entrepreneur, as she called herself, a serial entrepreneur, they're looking for an exit strategy, aren't they? They want to sell the company or close the company down when it's done well, right? You know, that's part of the going concern. When do I want to sell the company? How long can the company last? These are important questions. Call it the going concern. Another assumption we have in accounting is called the monetary unit. Is it measured in dollars? Is it measured in euros? Is it measured in pounds? Is it measured in pesos? Very important to understand what the monetary unit is. Third assumption is called the business entity. What kind of business is it? Is it a sole proprietor? Is it a partnership? Is it an enterprise? Is it an LLC? Is it, so many different assumptions when it comes to the business entity. And then the fourth assumption is called the time period assumption. This is the life of the company can be divided into time periods such as months, years, days, quarters. Those are the assumptions. Hopefully you've all had the opportunity to go through Introduction to Business at some point. If you haven't, here's a little bit of it. There are 4 different types of companies. These are typical, yeah. Sole proprietorship, partnership, corporation, LLC. Sole proprietorship, that's just you. You own a business, it's just you. There's no one else, it's just you. Okay. They're easy to set up. The owner is typically the one that's reliable, that's liable for debts. Everything's personal. Yeah, when it's a sole proprietor, it means it's just you. A partnership, it's a business with 2 or more people that own part of the business. A corporation is when the business owns itself and everyone else is an employee of the business. That's a corporation. An LLC is a limited liability company where the partners or the individuals that own the company are limited to liability. They're not personally liable for debts. That's LLC. LLCs are nice. I like LLCs. So for those of you who are in business, getting into business, think LLC. Sole proprietorship is very dangerous because if something goes wrong and one of your customers decides to sue you for whatever reason, they go after your personal stuff. You don't want that. You want the LLC. They can only go after the business's assets, not the owner's assets. So for those of you who are in real estate and you're like, oh, Dr. B, I'm thinking about buying a couple of houses or whatever, consider the idea of putting each property into its own LLC. Why would you do that? Well, because you want the liability to be limited to just that property, not all your properties. See what I'm saying? Just think about it. Accounting constraints. There's a cost benefit to doing pretty much everything, right? Like, for example, you're taking this class, but you could be working. Yep. That's the cost benefit. The benefit is you're gaining knowledge by you being in this class. What are you giving up? You're giving up the opportunity to make more money by working, right? That's what we call cost benefit. We identify the cost that needs to be disclosed, and we identify the benefit, which is the cost of what you're giving up. Cost benefit. And the other accounting constraint is called materiality. We only make decisions based off of the information we have. And that information needs to be reasonable. That's called materiality. It's just a legal term. Don't worry too much about it. I'm just telling you about it. Oh, here we go. Are we ready? Are we ready? Here, my friends, very important, the most important thing you'll learn in this entire course. The accounting equation. Here it is. Oh, the accounting equation. The accounting equation is the most important thing because it is the foundation of everything you will learn in this course and in Principles 2 and in your business. Here's what it is. Assets equals liabilities plus equity. I'm going to break it down for you. Assets. The word asset is what the business owns. Assets are what the business owns. O-W-N-S, owns. What the business owns. That's assets. Assets include things like cash. Cash is an asset. Yeah, I own cash. Cash in my pocket. That's an asset. Cash. Accounts receivable. Accounts receivable is when a customer owes the business money. A customer owes the business money. To the business, what is owed to the business is called accounts receivable. That's an asset because the business has a claim to that asset. Asset, accounts receivable. Land, yes, asset. Property, land, equipment. Those are all assets. We call that property, plant, and equipment. Those are all assets. Land is included in there, yes. Those are all assets. It's what the company owns. So the equation is assets equals liabilities plus equity. The word liabilities. A liability is anything that the company owes. O-W-E-S, owes. A liability is anything the company owes to someone else. That is a liability. I owe them the money. I have not yet paid the money. It is a liability. Why is it a liability? Because they can take a claim to my assets. It's a liability. It's a liability. liabilities. Here's what liabilities include. Accounts payable. Accounts payable. Accounts payable is when the company received a bill but has not yet paid. That's an account payable. I received my electric bill, but I have not yet paid it. That's an accounts payable. Another example would be wages payable. My employee worked for the 2 weeks, but I have not yet paid my employee. That's called wages payable. Taxes payable. I accrued my sales tax, but I have not yet paid it to the state. That is taxes payable. Anything payable is a liability. Other liabilities include things like short-term liabilities and long-term liabilities. Short-term liabilities would be like things that are current. You owe them within a year or less. Long-term liabilities include things like a mortgage, a student loan. That's a long-term liability, my friends. Student loan, that's a long-term liability. A mortgage, that's a long-term liability. Long-term means greater than 1 year. Short-term, less than 1 year. Short-term, less than 1 year. Long-term, greater than 1 year. Current, less than 1 year. Long-term, greater than 1 year. So liabilities, anything the business owes to someone else. And the last part of the equation is equity. Equity is what, hear me out now. Equity is what the owners own. The owners of the business own. That's called equity. Equity. Okay, equity is contributions that the owners have made to the company. We call that owner's capital. Minus any withdrawals. A withdrawal is when the owner takes cash out of the business, usually to pay themselves. Plus revenues, which are from sales, minus expenses, which are from sales. That is all equity. Equity. That's what the owners own. That's what it equals. Assets equals liabilities plus equity. This accounting equation is always going to be in balance. It'll always be equal. Assets will always be equal to liabilities plus equity. Where that equal sign is, that same amount is going to be on both sides. Revenue minus expenses is called net income. We'll talk about that when we get to the income statement. Now, accounting is all about that accounting equation. Assets equals liabilities plus equity. We in accounting record business transactions. That's what accounting is. We're recording business transactions. Every business transaction has an effect on the accounting equation. Now I'm going to go through a bunch of different examples with you real quickly. The first one is when an owner invests cash into the business. So let's say you're interested in starting your own real estate business, okay? Well, how do you do that? You got to pump some money in. How do you start any business? Let's say you're starting a crochet business. You got to pump some money into that business to get it running, right? Of course you do. You got to get money off to start the business. Well, what do? You get cash into the business. So in this example, Chase is putting some money into the business. $30,000 to start his business. It's called Fast Forward. I don't know what they do. They make signs maybe. So here's what we do. When cash goes into the business, we debit cash. Okay, debit cash. Why do we debit cash? We're putting cash into the business. The reason why it's a debit is because anytime we increase an asset, like cash, we debit the asset account, in this case, cash. So debit cash to increase cash. So my first transaction will be cash, $30,000. It's a debit. The second transaction, part of that transaction, is we're going to credit paid in capital to the person's name. And it's an equity account. And that's how we increase an equity account, is we credit an equity account to increase the equity account. So here's how it looks. We're putting cash into the business. What are we getting out of that? We're getting equity. Cash coming in. Equity going to the owner. Coming out. $30,000 goes into the business. So we're increasing assets by $30,000. We're also increasing equity by $30,000. We see that the accounting equation is still in balance. 30,000 equals 30,000. So that's the first transaction. Here's the second transaction. The company needs to purchase supplies. Got to get the business going. Got to purchase some supplies. Absolutely. Two parts of the transaction. We're going to debit supplies. First, we debit supplies to increase supplies. It's an asset. Supplies, think of it like inventory supplies. And we're going to credit cash to reduce our cash. We credit cash to reduce cash. We debit it to increase it, and we credit it to reduce it. Increase cash, debit. Decrease cash, credit. Anytime we increase an asset, we debit. Anytime we decrease an asset, we credit. Increase debit, decrease credit. So the second transaction, I'm buying supplies. I'm reducing my cash, but I'm increasing my supplies. Notice, I'm only affecting the assets when I do this, decreasing cash and increasing supplies. But the accounting equation is still in balance. All I'm doing is I'm taking it from cash and putting it in supplies. I'm only affecting the asset side of the equation, but the total accounting equation is still in balance. 30,000 is still equal to 30,000. And it will always remain in balance. The third transaction, I'm purchasing equipment. Guess what? Equipment is an asset. I use equipment to make additional cash, or to make additional sales, I should say. I'm going to debit equipment by $26,000. I'm going to credit cash by $26,000. Increase equipment, decrease cash. They're both asset accounts. So again, this third transaction, I'm only affecting the asset part of the accounting equation. We're still in balance. 30,000 still equals 30,000. The fourth transaction, I'm going to purchase supplies on credit. Oh, here we go, on credit. When you purchase on credit, that is a liability, my friend. Every time you swipe that credit card, that you're increasing your personal liability. Liability. Why is it a liability? You got to pay that credit card, my friend. Yes. A credit card is a liability. Personally, it's a liability. Why is that? Because you have to pay it later on. That's why it's a liability. Remember, a liability is anything the business owes to someone else. So I'm purchasing some supplies. We'll call it inventory. On credit. On credit. When you hear the word on credit in accounting, it means on account. On credit or on account, they both mean the same thing. Accounts payable or accounts receivable if it's money that you're supposed to be getting in. But it's accounts payable because we're purchasing on account or on credit. So we need to pay that later on. So since we're purchasing supplies on account, I'm going to debit my supplies to increase my supplies. I'm going to credit my accounts payable to increase my liability, my accounts payable. So I debit supplies, asset, right? I debit my assets to increase my assets. I credit my liabilities to increase my liabilities. Now, when I go to pay that later on, when I go to pay that bill, that $7,100, then I would debit the accounts payable to reduce the liability, and I would credit cash to reduce the asset. So that way they remain in balance. It's always important that the accounting equation stays in balance. And we looked at a couple of different transactions. Here's another transaction. This one is when, what is this one? This one is when we're going to talk about sales, and we're going to talk about expenses and things like that. So our company, we do consulting. Okay. So I did some consulting for a customer recently for $4,200. The customer was nice enough to pay me right away. That's nice. Okay. It usually doesn't work that way, but it's nice when they pay right away. So I provided services. They gave me cash. That's a transaction, right? I'm going to debit my cash to increase my cash. And I'm going to credit sales. I'm going to credit sales or services to recognize the revenue that I earned. So I debit cash to increase cash, and I credit sales, which is a revenue account, to increase my revenue, recognizing my revenue. Revenue is an equity account. So on the accounting equation, I increase cash, asset. I increase equity, revenue. Here are two more transactions. I'm paying expenses. I'm paying rent $1,000. I'm paying my employees $700. Those are two expenses, right? Rent is one expense. Employees, another expense. I'm obviously using cash. I'm going to pay my rent. I'm going to pay my employees with checks, of course. Checks and cash are the same thing. A check is as good as cash. Yeah, same. So I need to record my expenses. I debit my expense account, in this case, rent. I debit rent expense to increase the rent expense. And I credit cash to reduce my cash. I'm also going to debit my salaries expense to increase salaries expense. And I'm going to credit cash to reduce my cash. We see that the accounting equation is still in balance, right? My rent expense went up. My cash came down. My salaries expense went up. My cash came down. Expenses went up. Cash came down. The accounting equation is still in balance. Cash comes down. Expenses go up. Expenses is part of equity. Yep. The two are always in balance. Assets equals liabilities plus equity. No matter how many transactions you have, it'll always be that way. Another transaction. I provided services to my customer. I sold some money on credit. On credit. What does it mean? They're going to pay me later. When a customer pays you later after you've provided the goods or services, that's called an accounts receivable. For example, I sent you that crochet pillow you ordered from me. Pay me within 30 days. Right? You send them the bill. So the crochet pillow, you sent that to your customer. Customer said, I'll pay you in 30 days. Or you said, hey, customer, pay me in 30 days. That's what we call an account receivable. You expect to earn that revenue from your customer, You earn the revenue, but you have not received the cash. That's called account receivable. Account receivable is basically a promise that your customer will pay you. That's account receivable. So in this transaction, there's actually two separate transactions here. I provided consulting services for $1,600, and I earned some rent from my customer, $300. So account receivable, $1,900 is what I expect to earn from my sales, right? $1,600 plus $300 is $1,900. The accounting equation is still in balance. Nice how that works. What
Sir, I
about?
have a question.
Yes, ma'am. Please.
So the 1900, is it debit? It's
Yes. Yep. So we debit 1,900 because it's assets, right? To increase an asset, we debit the asset. So in this case, we debit accounts receivable 1,900. We credit accounts receivable 1,900.
okay. So we debit the revenue,
Yes. Yep. Which is
even
the sales.
if we didn't receive the money yet.
That's correct. So that's a part of the revenue recognition principle. I recognize revenue when the goods or services have been provided to my customer. That's when I recognize revenue, regardless of when you actually receive the cash. Make sense? I recognize revenue,
Yes.
provide the good or service, not always when I receive the cash.
The money. Okay. And it's 1900 for the receivable is credit, not a debit.
Correct. Yep.
Debit the revenue.
We credit the revenue.
What about the account receivable?
So account receivable, I debit.
Because we cannot have both of them credited or both debited. One
Correct.
should be credit, the other debit, right?
That's correct. So I debit accounts receivable to increase the account receivable. I credit sales, which is a revenue account. So I debit account receivable, credit sales, revenue. What that does is it makes sure that the accounting equation is in balance, right? I'm recognizing my sales. I increase sales by crediting sales. Increase sales by crediting sales. So revenue is a credit account normally. Does that make sense?
Yes, thank you.
Great. Awesome. Thank you. Good question. Now it's time for me to get that cash from my customers. I'm going to receive some cash from my customers. Remember, they owe me $1,900 because I provided the goods and services. They haven't paid me yet. That's why I debited my accounts receivable and I credited my sales. Now, separate transaction, they're going to pay me. I don't reduce my sales. Sales only goes up. But what does happen in a separate transaction is I receive cash and I reduce my account receivable. The way to think about this is accounts receivables and accounts payables, for that matter, we call those contra flow accounts. They go up and down. Accounts payable and account receivable goes up and down based on what's happening. When I receive cash from account receivable, I reduce the account receivable. When the account receivable goes up, the sales goes up. That's the first transaction. The second transaction is cash goes up, account receivable goes down. Account receivable is what we call a contra flow account. Goes up and down based off what's happening. So what happened here is I'm only affecting the asset side of the equation. Cash went up, accounts receivable went down. Equation is still in balance. Okay, let's see what's going on here. We're paying $900 as a partial payment for a transaction. Cash goes down, accounts payable goes down. I'm just simply paying a bill. Cash goes down, accounts payable go down. Just paying a bill. Still in balance. Still in balance. The owner's taking some cash out of the business for personal use. Isn't that nice? $200. Accounting equation is still in balance. Withdrawals went up, cash went down. Withdrawal went up, cash went down. Debit withdrawal, credit cash. And this is a summary of all the transactions that we just talked about. We can see at the end of this wonderful list is that the balance, it's still in balance. It's still in equilibrium. My assets, total asset amounts, equal my liabilities plus equity amount. Still in balance. Isn't that nice? Financial statements and accounting are all interrelated. Esmera, let's see. How does it look if the funds are received in a different quarter or a year? Also, if you end the year with accounts receivable, is the business expected to pay taxes on that? Yes and yes. Okay, here's how it works. Esmera, great question, by the way. We recognize revenue when it's incurred, okay? So let's say I make a sale in December. On December 31st, I made a sale to my customer for a crochet pillow, all right? The customer hasn't paid me yet, but I made the sale on December 31st. I sent the pillow to them December 31st. They haven't paid me yet. That sale on December 31st, that counts for last year. Doesn't account for 2022. It counts for 2021 because according to the revenue recognition principle, we recognize revenue at the time the goods or services have been received by the customer. That is regardless of when we receive cash. And that can happen in different quarters or years. So it's regardless of when cash is received. Cash is so totally separate from when revenue recognition happens. The other part of your question here. We pay taxes on all revenue, regardless of the cash that's been received. So yes, we still have to pay taxes even if we haven't received the cash yet. Yeah. Sorry, that's the way business works. Good questions. The accounting statements. Let's talk about them real quick. We have the income statement, balance sheet, statement of cash flows, statement of owner's equity. These are the four primary accounting financial statements. The income statement. This is how we start all businesses with the income statement. The income statement records the revenue from sales and the expenses from expenses related to those sales on a monthly basis. Okay, monthly basis. The income statement, we record revenue from sales and expenses every month. So, sales from the month of December are on my December income statement. Expenses from the month of December are on my December income statement. Revenue and expenses. Here's how the income statement works. Revenue minus expenses equals net profit or net income. Revenue minus expenses equals net income. That's very basic. Revenue minus cost of goods sold equals gross profit minus expenses equals net income. It's called a multi-step income statement. We'll talk about it. I'm just giving you the very basics. That's the income statement. The statement of owner's equity shows us changes in owner's equity based off of owner's contributions and owner withdrawals. The balance sheet is where the accounting equation lives. The balance sheet shows us the balances of assets, liabilities, and equity at any given point in time. So I could say, oh, what are my balances on January 12th? What are my balances? Look at my balance sheet. It'll tell me my balances as of January 12th. Balance sheet is a snapshot in the point in time. And the last financial statement is called the statement of cash flows. This is the cash coming into and out of the business, the physical cash. Cash coming from our customers and cash going out of the business for various reasons. There are 3 different types of cash flows, and we're going to talk about those here in a second. Here's what they look like. The income statement shows revenues and expenses and net income. Revenues minus expenses equals net income. Total revenue minus total expenses equals net income. Net income is related to the financial statement, the other financial statements. Net income relates to the statement of owner's equity because net income is a part of equity, right? Revenue minus expenses is equity, net income. Revenue and expenses are technically a part of equity, but revenue minus expenses equals net income. Net income is reported on the statement of owner's equity. Investments plus net income equals total net income minus ending withdrawals equals ending balance owner's equity, which is a part of equity on the balance sheet. Assets equals liabilities plus equity. We see that total assets equals total liabilities plus equity. That's generally what they look like. And the last financial statement is called the statement of cash flows. In the statement of cash flows, we have 3 different types of cash. We have cash flows from operating activities. That's day-to-day operations of the business. Cash coming in from customers, cash going out for expenses. We have investing activities. That's the purchase or sale of property, plant, or equipment for the business. And we have financing activities, which is things like stocks, bonds, or other owner investments or withdrawals. Those are financing activities. That's how we finance the business. Loans, things like business loans, things like that would be financing. So operations, think day-to-day operations of the business. Investing, that's property, plant, or equipment. That's investing activities. And financing activities is things like loans, owner investments, owner withdrawals, stocks, bonds, those types of things. Those are financing activities. And of course, we can't have any chapter without at least 1 or 2 ratios. Ratios are used by management to quickly evaluate the financial health of the business. The first one is called the return on assets. This tells us how well we are using our assets to effectively generate revenue for the business. And return on assets is calculated by taking your net income, which is found on your income statement, divided by your average total assets. The average total assets is found on the balance sheet. It's not a simple line item, though. How do we calculate average? Average is something plus something divided by something else, usually 2. In this case, to find the average of anything in accounting, we take the beginning balance plus the ending balance divided by 2. That's how you get your average. In business, we also calculate risk. What is the risk to our business? How do we calculate risk? We perform what's called a risk analysis, or the return of asset as a risk analysis. We're not going to dive too deep in this course, but also with operations, we use cash in business to do things like plan for operations, investing, and financing activities. Every business has to have a plan, business plan. What are we going to do with the cash we get from our business? These involve things like investing activities. This is the purchase or sale of property, plant, and equipment. Financing activities is when we acquire that cash for the purpose of investing from owner financing, non-owner financing, from banks, from investors, from things like stocks and bonds, etc. Then operating activities is the day-to-day operations of the business. This is generating sales, and expenses. That, my friends, is the end of the first chapter of this course. Any comments, questions, or concerns about the things that we just covered for the first chapter? I know we're getting close to time. Yeah. Y'all okay? You're all still awake?
Yeah, we're
No
still awake.
questions.
I know it's a lot on the first day. I know. It's
I'm still here.
I'm still copying the notes, Professor.
I know.
I'm just gonna re-look it through the PowerPoint if I missed anything. I'm just like my eyes open. I'm just staring. I'm like, I must take all this information.
I know it's a
I'm
lot.
trying.
It's a lot to take in on the first day. It really is. Okay, great. I'm going to stop this recording and then we'll talk a little bit because I don't know if we'll be able to get through all of chapter 2 in 8 minutes. I highly doubt that. So hold on a sec. Let me stop this recording.